Hey everyone, welcome back to Corporate Decoder, where we try to peek behind the curtain of big business and see if their stories add up, or if they're just trying to pull a fast one with fancy finance terms. Today we're looking at Baxter International Incorporated's latest report. You know, Baxter, right, the medical products giant. Well, they've been busy making some interesting adjustments to their financial agreements, and we're going to decode exactly what that means for you and for the company. Make sure you are subscribed because we break down these complex filings so you don't have to, and join our Discord in the description below to keep the conversation going. Baxter International Incorporated has made a bit of a financial tweak. It seems they've amended an existing credit agreement. Now, usually when companies amend credit agreements, it is to get more flexibility or to adjust how they measure their performance. And in this case, it's all about their leverage ratio. So what does this mean in plain English? Think of a leverage ratio like a company's debt to income ratio. It shows how much debt a company has compared to its earnings. Lenders like banks want to make sure a company can handle its debt. If the ratio gets too high, it is a red flag. Baxter has essentially renegotiated this leverage ratio. They're asking for a little more breathing room, specifically increasing the maximum net leverage ratio allowed for the next few quarters. This means they can carry more debt relative to their earnings for a little while longer. They're looking at the end of 2025 and most of 2026. Now, why would a company do this? It usually suggests they anticipate a temporary dip in their earnings or an increase in their debt, perhaps due to investments, market conditions, or maybe even some unforeseen challenges. It is like saying we might not be as profitable in the short term. So please allow us a higher debt ceiling. It is not necessarily a sign of immediate trouble, but it is a signal that management is looking ahead and proactively managing their financial covenants. Now, Baxter International Incorporated is a pretty established player. They're involved in medical devices and healthcare solutions. You've probably heard of them for things like IV solutions, dialysis equipment, surgical products, and more. They're a large global company, and like any large company, they operate within a complex web of financial agreements and market forces. Their stock is traded on the New York Stock Exchange under the ticker BAX. Looking at their registered securities, we see their common stock with a par value of $1 traded as BAX on the New York Stock Exchange. They also have 1.3% global notes due in 2029, also listed on the New York Stock Exchange under the ticker BAX29. This tells us they are raising capital through both equity and debt instruments. The amendment we're discussing today directly relates to how they manage their debt obligations under these agreements. This filing is categorized under Item 1.01, which is for entry into a material definitive agreement. This just formalizes that they've signed off on this amendment to their credit agreement. Remember, this credit agreement is a 5-year deal originally inked back in June of 2025. So, this is an amendment to that existing arrangement, not a brand new loan entirely. The parties involved are Baxter International Incorporated, acting as the borrower representative, along with other Baxter entities as borrowers, and then you have various lenders and JP Morgan Chase Bank National Association acting as the administrative agent. Now, while this filing doesn't contain extensive financial tables in the traditional sense like a quarterly earnings report, the core of it is the financial maneuver with the credit agreement. The material aspect of this agreement change is what we're focusing on. Changing debt covenants can have ripple effects. For instance, if the company were to breach a covenant without this amendment, it could trigger penalties, require immediate repayment of the loan, or lead to more restrictive terms. By proactively adjusting the net leverage ratio, Baxter is aiming to avoid these potential issues and maintain a smoother operational flow. Let's put on our Warren Buffett hat for a moment. When a company revises its debt covenants upwards like this, it is a signal worth paying attention to. It suggests that management foresees a future where their current debt levels might exceed the agreed upon limits based on their projected earnings. This isn't necessarily a crisis, but it does highlight increased financial risk. It's like a homeowner saying they need to raise their credit card limit because they expect a few larger expenses coming up. You want to know why those expenses are coming up and if they have a solid plan to manage them. For Baxter, this move could provide short-term flexibility. It allows them to perhaps pursue strategic initiatives, make acquisitions, or navigate challenging market conditions without the immediate pressure of a covenant breach. However, from an investor's perspective, it also means that the company is carrying more debt relative to its profitability, at least for the period covered by the amendment. The real test will be how they perform in the coming quarters. Can they either improve their earnings to bring the leverage ratio back down, or can they manage their debt effectively even with this higher ceiling? The other important takeaway is that this amendment is for a specific duration. It's not a permanent change. This suggests that Baxter likely views this as a temporary measure to navigate a particular period. Looking at the dates, they're looking at the rest of 2025 and through the third quarter of 2026. This timeframe is crucial because it covers periods where significant business events or market shifts might occur for Baxter. This report also includes a section for exhibits. These are the actual documents that support the information in the report. In this case, the most critical exhibit is Amendment Number 1 itself, which is attached as Exhibit 10.1. This is where you would find all the fine print of the agreement change. And to wrap things up, we see the signature of Ellen K. Bradford, Senior Vice President and Corporate Secretary, signing off on this report on the 25th of November 2025. This indicates that the company is formally acknowledging and filing this amendment. So, what do we make of all this? Baxter International Incorporated is making a calculated move to adjust its financial flexibility. They've proactively amended their credit agreement to allow for a higher net leverage ratio through the third quarter of 2026. This suggests management anticipates a period where their debt might be proportionally higher relative to their earnings. The strength here is Baxter's proactive approach. They're not waiting to hit a problem. They're addressing potential covenant issues in advance. This shows good financial stewardship in managing agreements. However, the weakness, or at least a point of caution, is the underlying reason for this adjustment. Are they anticipating a downturn in sales, increased costs, or strategic investments that carry significant debt? The market will be watching closely to see their earnings performance in the coming quarters. An opportunity for Baxter could be using this newfound flexibility to invest in innovation or strategic expansion that bolsters long-term growth. A significant risk is if the underlying business performance doesn't improve as expected, they could find themselves in a more precarious debt situation when this amendment expires. In conclusion, this isn't a dramatic announcement, but it is a significant financial adjustment. Baxter is essentially buying itself some breathing room. The key for investors and observers is to track their financial performance and understand the strategic rationale behind needing this extra room. Alright, that is our breakdown of Baxter International Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this is a smart move or a cause for concern? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps the channel, and subscribe for more deep dives into corporate filing. Don't forget to check out the Discord community link in the description to keep the conversation going. Thanks for watching, and see you next time on Corporate Decoder.